Now, one of the biggest frustrations that you can have as a forex trader is not knowing which zone is going to hold and which zone is going to be successful. In today's video, I'm going to break down exactly what you need to do in order to differentiate between the bad zones and the good zones within the forex market. Make sure you like this video, subscribe to this channel, and without further ado, let's proceed. So right now we are going to witness a formulation of a supply zone. Okay, there we go. So this move to the downside created this supply zone to the left. This blue candle is our supply zone. So now that we have established that, we are going to draw out the whole of the supply zone just like so. So how do we know if this 4H supply zone is going to hold? We do not know yet. We need to do our investigation. How do we do that? From 4H, we drop down to 1H. Okay. Now that we're on a 1H time frame, we need to identify another supply zone within the 4H supply zone. So right here we have this blue candle. We'll draw it into the future. I'll make it black so that you can see exactly what is happening. There we go, right here. So the bigger box is the 4H supply zone and the smaller box is the 1H supply zone. Let's make the text white. There we go. So in a nutshell, what you are looking for is for the 1H supply zone to occupy a relatively sizable chunk of the 4H supply zone. Once again, what you are looking for is for the 1H supply zone to occupy a relatively decent size, a decent portion within the 4H supply zone. This just means that this 1H supply zone, supply candle, actually has what it takes to push the price to the downside. So let's play the price and see what actually happens. And there we have it. This is how to identify good, strong supply zones. That's example number 1. Let's proceed to example number 2. So whenever you see that there is a massive wick rejection that has happened on the 4H time frame, what you can do is mark this wicks like so, go it to the future. Okay, so this is now our 4H wick rejection area, just like that. Okay, now we need to drop down to 1H. This 1H demand is occupying the same area as the 4H wick rejection area. Okay, so this is a strong confluence that this 1H demand zone actually has what it takes to push the price to the upside. So whenever you see that your 1H demand zone is occupying literally the whole of the 4H wick rejection area, that's a strong indication that this demand zone has exactly what it takes to push the price to the upside. Let's play the price. Boom. There you have it. Let's proceed to example number 3. So right here we have a chart pattern which has already formed. It's called rally, base, rally. This is the rally, the first leg, second leg is the base, and the third leg is another rally. So within this rally, base, rally chart pattern, we can see that we have a demand zone right here. So we'll draw it into the future. This is our 4H demand zone area. Okay, but how do we know if this demand zone is going to hold? Guess what? We have no idea until we do investigation. We need to drop down to 1H time frame and see if the 1H time frame is occupying a large territory of the 4H demand zone. If it is, then that's a strong indication that this zone is going to hold. Now we are on 1H time frame. We can see this doji demand zone right here, flow into the future like so. So as you can see, this blue area is occupying practically all of the 4H demand zone area. These are the things that you are overlooking. Pay attention to what is happening in the forex market. These things actually mean something. So when you identify your demand zone, this is it right here, this candlestick right there. This is the area of influence. So we have 2 areas, we have 2 candlesticks, we have 2 zones, and we have 2 confluences, and they're both occupying the same area. So now let's play the price. And there you have it. Whenever you have 2 zones occupying the same area within the forex market, on the higher time frame and on the lower time frame, this phenomenon is what I personally call zoning. Whenever we are layering time frames from 4H to 2H to 1H, and that's how you identify whether a demand zone is strong or weak. Now we are going to proceed to examples where The demand or the supply zone did not have what it takes to hold the price and to push it in the other direction. Let's proceed to example number 4. So here we have a demand zone that has formed right here. We have an impulsive move to the upside on 4H time frame. So we draw out this demand zone. So what we are expecting to happen is for the price to retest this area and continue going to the upside. Okay, this demand zone also broke higher time frame structure. So right here we have our break of structure. So we have several confluences which are showing us that this is a decent demand zone. But in reality, this is not always the case. Within this 4H demand zone, we need to identify our 1H demand zone. This 1H demand zone, we need to go backwards. So this is our bullish candle, bullish candle, bullish candle. This is our first bearish candle right here. So the first bearish candle, this is our first bearish candle. This is our demand zone. This is now our 1H demand zone, okay, within the 4H demand zone. So pay very close attention to the amount of space and the amount of area that the 1H is occupying within the 4H demand zone. We have a lot of empty space. We have a lot of area that this 1H demand zone is actually not occupying. This is actually imbalanced, and whenever we have imbalances right before our 1H demand zones within a higher time frame of 4H demand zone, what tends to happen is this: the price breaks the zone, and as you can see, this demand zone did not have what it takes in order to hold the price and push it to the upside. Just like this, it did not have what it takes. That was example number 4. Now we're going to proceed to example number 5. This one is going to be epic. So right here we have a powerful bearish candle. This bearish candle actually broke structure. So right here is our break of structure, BOS. This is our supply zone. That's our supply zone. So we mark out this supply zone just like so into the future, and now we are anticipating for the price to retest this level and continue to go to the downside, break and retest on a higher time frame. But before we do that, we need to drop down to 1H time frame and qualify this actual zone. Okay, so now that we are on 1H time frame, this is now our point of interest. Right there, zoom in, identify our 1H supply zone. Right here we'll have 1H, and the 1H is occupying a very small portion of the greater 4H supply zone. Now that is a red flag. A second red flag is the fact that we have this huge imbalance. Okay, imbalance is when one candle is so impulsive that the wicks of the previous candle and the next candle do not touch each other. So this whole area is actually an imbalance. It looks so perfect. It looks so fantastic. Let's play the price. Okay, it looks like as soon as price is going to reach this level, we should be looking to sell the price like so. But what happens instead? The level gets broken. The level didn't have what it takes to push the price to the downside. And the biggest sign that we need to observe is whenever there's a huge, very impulsive move coming from the 1H supply zone. Another sign that we should not have taken this trade is the fact that the 1H supply zone does not occupy a big proportion of the 4H supply zone. Another confluence that lets me know not to take this kind of trade is when the 1H supply zone is not occupying enough territory within the 4H higher time frame supply zone. There we go. You have had 5 examples. Do you want another example? Okay, let's proceed to example number 6. We have a chart formation called rally. So we have a chart formation here called rally, base, drop. Right there that has formed. This drop actually broke structure at this level. This is an official break of structure. So now this means that this candlestick over here is our supply zone. This only means one thing. This means that whenever the price is going to retest this area like so, we should be anticipating a move to the downside and collect those pips. However, before we do that, we need to drop down to, guess what, 1H time frame. 1H time frame is what we need in this situation. And what do we see? What do we see? Okay, we need to count backwards. Black, 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 blue. The first blue candle, this is our supply zone. Nice and easy. Remember the statement: simplicity scales, complexity fails. Keep it simple. 4H, 1H. So let's look at the price properly. Red flag number 1. Our 1H supply zone is hardly occupying any area within the 4H supply zone. Okay. Red flag number 2 is that we have an imbalance that came from this supply zone. So all the price is going to be concerned with doing now is trying to fill this imbalance. Price loves to balance itself out. Whenever the price goes strongly in one direction, it tends to go back to fill the gap. That's also called the fair value gap. So when we see fair value gaps form after supply zones and the price is very, very impulsive like this, then there's a high chance that the price is going to break this supply zone. So that being said, let's play the price and see what actually happened. There you have it, ladies and gentlemen. These are the things that you need to watch out for. These are the things that you need to implement into your trading strategy. So there you go, ladies and gentlemen. I showed you 6 examples, 3 examples of good supply and demand zones, and 3 examples of what to avoid in the forex market. Protect your capital. That is the priority. Risk manage. Like this video. Subscribe to this channel. I've got more to come. I am Toxability. I'll see you guys in the next one. Take care.